Okay. So, uh, what happens when you exchange assets? So, while exchanging two assets, how do you measure the cost? Hmm? You have to take the fair value of each asset and see whether this is resulting in a. So, you have to de-recognize your original asset and plan this asset. This transaction will result in profit and loss or not? No profit and loss. It may. So, that has to be recorded in profit and loss. Okay. So, and yeah. And if it is not able, I mean, if you can't get fair value reliably, or this is not an exchange that has any commercial substance, then you take the carrying value of the asset transfer, right? So, if the item is not acquired fair, its cost is measured the carrying value of the asset. If there is no indication, then you have to use carrying value. Okay. Now, measurement subsequent to initial recognition. Now, what did we do? We initially recorded at what? Cost. Absolutely. Initially, we did like, purchase price plus input, refundable taxes plus other things. Any cost which is ready to, I mean, which makes the asset into its present location and condition, we capitalized. Now, going forward, you have two options. I think you guys know this. How do you go? What options do you have? What is cost model? Cost minus accumulated portion minus environment. Very good. And what is revaluation? The carrying value to compare with the fair value. The gain or loss. Gain will be earned. What is revaluation model? Just like how we told a formula to find cost model, subsequent recognition. How do you subsequently recognize whatever is the cost? Initial cost minus accumulated depreciation minus accumulated impairment loss. You will get the carrying value of the asset. Right? That's how you record subsequently after initial recognition. Now, what about revaluation model? How do you do? What is the market value? Say fair value. We'll use the word fair value. Okay. Plus or minus the good. DRL, which will be revalued to the fair value of the asset. Okay. And any. So there won't be any depreciation. No, depreciation will be there. Like why would I have to give depreciation on the year in which I calculated the fair value? Say, for example, I bought the asset in 2024. 2024, I bought it for $100. 2025, I see that it is 150. Okay. So what would be the entry? What would be the entry as per revaluation model? We need to see the carrying value of that asset. Or market. That's what I'm saying. I purchased it for 100. Right now, the fair value is 150. Yeah. Deducting depreciation, the carrying value. It's just the first year, man. So how do I go about it? Service. 150 minus 100. Asset debit reserves and surpluses. Gain. Credit. Gain to asset as no gain. Credit. Debit asset. Debit asset. Debit asset. Credit revaluation gain. So no depreciation. But depreciation. Okay, I'll give you an. 1 year depreciation. Okay, let's see. So year zero, say let's say 2024, I purchased an asset for 100,000. Okay. Now I am revaluing it on 2027. And the revaluation amount, let's say, is 85,000. Okay. The asset has a useful life of 10 years. Okay. And no scrap value. Okay. So I'll write it down here. 10 years useful life. Use straight line method and no scrap value. Now, how would I capture? What would be the accounting entry? You would tell me all this. Yes. What about
for including carrying
yeah, yes.
initial acquisition
Okay, 2024, I recognize cost. What would be the entry?
set connected to
Hmm.
cash.
So let's say PPE debit, bank credit, bank or AP. So how much? 100,000. Okay, let's say this is okay. Now what would be the entry?
Then depreciation, net asset, PP,
Okay. So 2024, what would be the entry?
depreciation,
Okay.
depreciation, credit,
Hmm?
credit PP,
No.
accumulated which.
There is nothing, you will never
Okay, okay.
see, when it comes to presentation,
Mm.
it's always another separate ledger called accumulated depreciation. Okay. So the PPV would only have its value. So depreciation to accumulated depreciation. Now to save time, what would be the amount? 10,000. Okay, how do I get 10,000? Can you give me the formula? No,
100,000 minus this
100,000 minus 0 divided by 10. Okay, never leave that. Now, for simplicity, can I write 24 to 2026? We will do the same entry. Okay. Now, what would be the entry for 2027? 2027. So, this, let's say that Jan 2024 is when we did this. And this is December 2024 to December 2026, we did this. Now it is Jan 27. Okay. What would be the entry? Now I am revaluing it to 85,000.
ಅದು ಜಾನ್ 27 revaluation നടക്കുന്നു.
Yes.
അത് നമ്മൾ carrying value നോ? Carrying value is 70,000. 100,000
So we'll calculate carrying value. It is actually 100,000 minus 10,000 into 24, 25, 26. Okay. Minus 30,000. Carrying value 70,000. Okay. Now, what is the entry? Okay. Okay. Debit to PPE. How much?
15,000.
Hmm? Okay.
Credit gain. Gain on revaluation. Credit debit accumulated depreciation.
Why would I have to increase my depreciation now? Accumulated depreciation. Okay. What would be the entry? This is where people go wrong. It might be very basic, but if you don't understand the presentation, then you're not talking like a IFRS person. So let me first, we have to calculate the amount. Okay, what is the cost? Cost of the asset, PPE account. What is the balance as of 2027? It is 100,000. That account is not getting credited at all, right? Then there is accumulated depreciation. It is 30,000. And this is credit. So can I give negative? So what is this amount called? It's called carrying value. With that, given that these two are is there any ledger for this? No. There are only ledgers for these two. Given that there are only ledgers for the two, what entry would I give? Okay, accumulated depreciation debit. How much? Okay. Hmm. Okay.
കുറയല്ലേ 15 കുറേ 15% gain.
Yes. Never go wrong. The only logic you need to identify is there are only two accounts. I mean, there are two ledgers, and this is not a ledger. If you understand that, these entries can be aced. Okay, very important. This is where people mess up. Now you tell me, Jan 27, do I have to give any depreciation? What would be the balance in each? Cost would be what? 85,000. Accumulated depreciation completely wiped out, right? Carrying values.
PP 85.
You are crediting PPE was 100,000. You are crediting 15,000.
So what if we revalue it to 90,000?
Okay.
Then what would be the entry?
So you want this 85,000 to be 90,000. Correct. So you are now, 30,000 is going to be your, so I would say that 30,000 is going to be your accumulated depreciation. And what would be the amount of reduction in the PPE if I make it 90,000 now?
10,000.
Exactly. What would be the revaluation gain? Why 20,000? To calculate this 20,000, we are taking the carrying value of this.
70 not 10.
70 minus 90 is 20. Should be clear. It's pretty simple. Only thing you have to understand is these are two ledgers. That logic would help you ace the understanding. Don't directly credit into carrying a value. PPE account does not hold the value of 70,000. It holds on a 100,000. Okay. So the formula for revaluation method is revaluation minus subsequent accumulated depreciation and subsequent impairment loss. Now in 27, Jan 27, would I do depreciation? Sorry, December 27, would I kind of do a depreciation exercise? How much would be the depreciation I would do?
On the remaining, remaining 5,000.
So that we have to calculate. So 85,000 minus 0, since there is no scrap value, divided by how many years are left?
7.
Divided by 7 years. Okay. Because 27, we didn't do any depreciation. So that is also a seventh year. Understand? So this was going to be the new depreciation. Okay. So what is the, that is why I'm telling you, there won't be any depreciation on the time at which the revaluation conducted. Let's say I gave it in Jan. Sometimes what they will give is I conducted a revaluation in December 27. Would you have to again give a depreciation entry? No, because fair value means that is the value you will get. So that means it is the replacement value slash the depreciated value you can take. You understand the logic. Are you getting this or not? So whenever there is a depreciation in Jan 27, since the depreciation, I mean the revaluation happened, you now know that December 27 you have to give a depreciation. Because a asset is 1 year old. What if the revaluation happened in December 27?
We would have already charged depreciation based on last.
Correct. And then we would have written off. Either that, but we will not again charge depreciation for the same year. We will only charge now in December 28. Alright? Because the fair value is equal to the replacement value. Okay. So this beware, that is the only main problem. Okay. So revalue, carry the asset at the revalue amount being its fair value at the date of revaluation, less any subsequent accumulated depreciation and subsequent accumulated impairment losses. I revised IAS 60 makes clear that revaluation model is only available if the fair value can be measured reliably. Obviously. Otherwise, I cannot use this method. Okay. Now we all know cost method. Now revaluation method, when should it be applied? When should it be ideally applied? When can you? No, can I use cost or revaluation? Anyone? Or should I use only cost or only revaluation? Hmm? My choice. No, it's my accounting policy. Right. Now I have different types of assets. I have machinery. I have land. Now land I am using revaluation model. Am I allowed to use cost model for machinery, or should I use revaluation only for all the assets or cost only for all the assets?
Same class of assets we need to use the.
So only for the class of assets, not for every asset. Okay. So if I am using it for land, then I have to kind of use revaluation model for all the land I own. Okay. So revaluation model is applied. The frequency of revaluation. What is the frequency of revaluation? Should I conduct every year? It is my policy, right? So it should be if it is very volatile asset, I'll conduct every year impairment testing. Sometimes I'll have goodwill from an acquisition which was made previously. I acquired a company previously, so I have some goodwill. Or if it is not such a very volatile asset, then I'll do every 3 years or every 5 years. I'll do an impairment testing. That is why they use minus subsequent depreciation. Getting it? If you have it in your mind that every year you'll do revaluation, then there won't be any minus subsequent depreciation, minus subsequent impairment gains. These 3 years, 5 years period is why there is a subsequent element that is given in the. Okay. So revaluation model, the frequency of revaluation depends upon the changes in fair value of the PPE being revalued. Items of PPE that are volatile to changing prices will be subject to an annual revaluation, whereas less frequent valuations may be suitable for items less subject to change. You don't need to be frequent. You can keep a policy like I'll do only once in 3 years. Hmm? Now, another question. Let's say that I have land. I have one land here in Sheikh Zayed Road and one land there in a desert in Mumbai. Okay. Now, Sheikh Zayed land is highly volatile, based on the ups and downs of the market. Obviously, its price is going to be up and down. But UAQ land is not very, it's going to be the same. It has been the same for quite a few number of years. So, can I take a policy that, this land I will revalue 3 to 5 years? I am taking revaluation for the same class of assets. I am using revaluation methodology. That I will revalue once in 10 years, and this I will revalue every year. Can I take a policy like that? You understood the question, no? Same class of asset, but different revaluation policy.
Screen should be gone.
Yeah?
Should be same. Company policy means company policy
No, I can or I cannot.
can.
Okay. Yeah, you can. Because if it is not getting very, not much change in the UAQ, what is the reason for doing yearly eval? So based on the empirical evidence, you can suggest that I will be using revaluation method only, but I will be revaluing only 1 to 2 years. Okay. The frequency of revaluation depend upon the changes in fair value of the PP. Items of PP that are volatile to changing prices will be subjected to annual revaluation, whereas less frequent valuations may be suitable for items less subject to change. Okay, never mess up. It may be the same. This is how the examiners will trick you. You need to kind of go deep. The asset should be revalued to fair value in accordance with IFRS 13. Okay, that's fine. If one asset is revalued, so must be the whole of the rest of the class of assets, either at the same time or on a rolling basis. Okay. What does it mean? Same class should be done either at the same time, just like both UAE, or on a rolling basis. Any increase in value is normally credited to OCI, obviously, right? It would not be coming in. Decrease in profit and loss after cancelling previous revaluation surplus. We'll go into that. But are you clear with revaluation model? Now, accounting for revaluation. This is what we saw, right? So, asset value to OCI. Now, what if there is a reversal? This is what we actually look like. So, this revaluation gain credit will not go to, it will go to OCI. Okay. Now, let's say in Jan 29, what happened is there was now a impairment. Okay. The value of the asset is now, let's say, carrying value of the asset is now how much? Let's say 30,000. Now, what you do? Carrying value. Carrying value. Or the fair value of the asset on revaluation. Okay, I'll keep fair value is now what you do? Before that, I have to see on Jan 29 what has been my exactly. What is the cost? 85,000. What is depreciation? So Jan 27, we did the depreciation and we calculated that the depreciation is going to be how much? Yes. So it is going to be 85,000 divide, let's skip negative minus 0 for a while, divided by 7. This is going to be my annual depreciation, right? 24, 25, 26. Now 27 to, right? This into 2 years, 27, 28. Jan 29 I'm doing. So the accumulated depreciation is how much? This. What would be the carrying value? Now the value is, let's take 50,000 now. Sorry. Hmm? Now it is 5 years, so I can take 50,000. Right? Now, what would be the entry first in Jan 29? It is a revaluation loss. Carrying value is 60,000, but the fair value is 50,000. And what would be the entry? Where, whom should I debit first? Well, whom should I credit first? Obviously, the cost should now be what? 50,000. Correct. So I will credit PPE. How much? 35,000. Right? Right? PP value. Now, what about subsequent accumulated depreciation? Do I need it or not? I don't need it, right? So I'll debit. Accumulated depreciation is 24,285.7. Now then, revaluation loss. Debit. Debit revaluation or impairment loss only, it will go to P&L. But what they say is, if there is a revaluation gain which is staying there, you have to first take it off, and the remaining should only be, yeah. So if I see what is my revaluation loss, it is 60 minus 50. How are they getting 60? By debiting this and crediting this. Okay. Right? By debiting this and crediting, they're not getting 60, they're getting 10. Right. But that is the whole logic. So 10,000 is going to be my total revaluation loss, out of which I already have a revaluation gain of 20,000. So what I'm going to credit is going to, what I'm going to debit my revaluation gain, which is in OCI, to what value? 20,000 minus. No, I will do 10,714 here, and my balance would be that. Okay. So subsequent revaluation loss, first set off the thing which is not required at all, then come back and go. Okay. So debit other comprehensive income, debit profit and loss if no revaluation surplus is available, and then asset purchase. Okay. See, even the books don't show that true value thing. By reading this, you would just credit PP. Don't do that. Do this. Examiner will actually kind of like reversing a previous decrease in value. Now, what if it is reverse? There was an initial decrease in value, and now there is a revaluation gain. So, what do? I have to previously decreased loss. Now I am increasing. Okay. So, after the credit on to profit and loss, any remaining would only be spent to same thing. Okay. It would be like a prior period error which is now changed, or a estimate change. So prospective, we will. Okay. So can we do that? Binky Co has an item of land. See, it is a land. So what is, whenever you see land, what should exactly? It's very important. Carried in the books at 13,000. 2 years ago, a slump in land values led to the company to reduce carrying amount from 15,000. Carrying amount from 15,000. Okay, it was 15,000 2 years ago. Now it is carrying value is 13,000. Okay, this was taken as an expense in profit and loss. There has been a surge in land prices in the current year. However, the land is now worth 20,000. So what you do? It was 15,000. It became 3,000, 13,000. So there was a $2,000 hit in the P&L as impairment loss or revaluation loss, as the case may be. Now, now it is 20,000. So now the revaluation OCI, how much would you be crediting in OCI? Total profit is how much? Total gain is 7,000. Out of which 2,000 I will give to credit to P&L, and 5,000 we will credit to OCI. Okay. You want to do a devaluation decrease also. This is what we did the example. Original cost valued upwards to 20,000 2 years ago. The value has now fallen to 30,000. So use the previous revaluation surplus first, and then okay. Now there is a further complication when the revalued asset is being depreciated. We saw that complication. It's just that you have to be wary. As we've seen, an upward revaluation means that the depreciation charge will increase. Normally, a revaluation surplus is only realized when the asset is sold. But when it is being depreciated, part of the surplus being realized as the asset is used. The amount of surplus realized in difference between depreciation. Okay. Now this is something different. So let's take an example that my asset value was 15,000. Okay, my cost was 15,000. And uh, okay, I purchased the asset in 2024. Okay. Uh, Now what I'm doing in 2027, there has been a revaluation surplus. Hmm? It has become what? It has become 20,000. Okay. 10 years useful life and no scrap value. Okay. Now you tell me what would be the entry that I will do in 2027. So Jan 27, what would be the entry that I do? For that, I have to find what? Exactly. We have to find the cost, carry accumulated depreciation and carry value. Correct. So 24, I purchased it for 15,000. Right. Accumulated depreciation is going to be 1,500 into 24, 25, 26. Okay, 3 years gone. So carrying value is how much? Hmm? Okay, this is very clear. Now, the value of the land is how much? The fair value. Hmm? Now the value of the land is how much? What is the current value? 21,000. So what is the gain? Okay. So what would be the entry? What would be the entry? Okay. First we'll do debit. Accumulated depreciation. How much? 4,500. Okay. Asset or PPE debit. How much? Hmm? It would be 6,000. How 6,000? Yes, exactly. Okay. Now, gain OCI is going to be okay, right? Now, what will happen if I do this? Now, let's say that there has not been any revaluation gain for subsequent years. This 10,500 will stay there, right? In OCI, it will completely stay. Now, as a matter of policy, what the guide says is you can choose to transfer this to retained earnings. It is so, you understand? You can transfer this to retained earnings. So this is going to be there in the SOCE, right? Revaluation surplus. But why it is there if we are not doing any revaluation before? There is a method in which you can slowly transfer this to retained earnings. Okay, how do you transfer to retained earnings? This is calculate what is the depreciation. So in December 27, what am I doing? I'm depreciating the asset. Correct. So what would be the depreciation? Depreciation to accumulated depreciation is what? 21,000 divided by 7. Okay. So it's going to be 3,000. Correct. Now, what is happening is every year you can transfer this revaluation gain to the extent of depreciation which was there before to the depreciation which is there now. So on a systematic basis, see 10,500 is going to be the revaluation reserve. So revaluation reserve also, this gain is what resulted in the depreciation becoming 3,000 from what? 1,500. Correct. What was the original depreciation? 1,500, right? How did I get it? 15,000 divided by useful life. Correct. Now, the depreciation charge to the P&L is becoming 3,000 only because of what? So, as a matter of matching concept, we will transfer that amount to which is proportionate to annual depreciation to evaluation reserve. So, what they say is uh, revaluation reserve. No need to keep that money there. From there, you transfer to retained earnings. How much? Value of current depreciation minus original depreciation. So 1,500 we will transfer to from the revaluation reserve to the retained earnings on a systematic basis over the difference of depreciation. So that what will happen? It is all a gimmick. If you see, the gain is 10,500. How much is the useful life remaining for the asset? So systematically over the life of the asset, we are transferring that revaluation reserve to retained earnings. Okay. Now, fundamentally, if you see this, you'll observe one thing. The revaluation reserve gain is not reclassified into, it will go directly from retained earnings into OC. Hmm? Hmm? OCI to retained earnings. It will never get reclassified into P&L. Okay. So this is how you will transfer the money. That is what is, see, normally a revaluation surplus is only realized when the asset is sold. Correct. But when it is being depreciated, the part of surplus being realized as the asset is used, the amount of surplus realized is the difference between depreciation charged on the revalued amount and the lower depreciation which would have been charged on the asset's original cost. This amount be transferred to retained earnings, but not through profit and loss. You understand the meaning of these words? Because I am earning more depreciation. Because so it makes sense to transfer, not keep this much money in the revaluation reserve, transfer it to retained earnings. Okay. Yes. Especially the difference also. When there is a decrease in the value of asset, depreciation charge will decrease. Then we will have depreciable assets and then a revaluation gain following a previous loss that was included from the amount of gain that has been credited to profit and loss is the original loss less any depreciation saved. Did you understand this?
Yes.
So, okay. Now we'll do this question. Crinkle bought an asset for 10,000 at the beginning of 20x's. It has a useful life of 5 years. Okay. On January 20x6, the asset was revalued to 12,000. So it's an upward revaluation or downward revaluation.
Upward.
The expected useful life has remained unchanged. That is 3 years remain. So I will do the entry. What is my revaluation surplus? 10,000 minus 2 years depreciation, right? Useful life of 5 years, 26 2006. So 2000 into 2, 4000 is the accumulated depreciation. So the carrying value is 6000. What is the revaluation amount? 12,000. 12,000 minus 6,000, the revaluation surplus is 6,000. Asset value is 2,000. Why? Because 12,000 is 2,000 over 10,000 and accumulated. See, now they have given that this is how you have to account. Okay. So now they have transferred to retained earnings 2,000. Now, tell me, how did you get this 2,000? I'll only show the center. They have transferred 2,000 to retained earnings. How did they get 2,000?
6,000 divided by
6,000 divided by 3.
new depreciation minus or minus
No,
depreciation.
no, you tell me how. Yeah.
Minus new depreciation minus old.
What is new depreciation?
12,000 by 3.
That is 4,000.
4.
Minus old depreciation is 10,000 divided by 5. So that amount is
6,000 divided by yes, okay, divided by 3.
why 6,000 divided by 3?
New reversion gain by
That's okay, but let's stick to the base formula because see, your thing will work if there is no subsequent revaluation, impairment loss, or anything. When there is subsequently something happening, then this formula will lose its value. So better to go by old depreciation minus new depreciation.
no, we are recovering every year. So this will be
That's I understand. I only showed you that 10,500 divided by 7 years, you'll get 1,500. You can use provided there is no subsequent revaluation loss or gain. It's going to be systematic. Once there is a subsequent loss or gain, that is only to understand logic. Okay, clear? That is revaluation. So spoke about few things. Revaluation, if you're taking it as a policy, it should be done on every class of asset, right? Then revaluation can
at a time or on a rolling basis.
yes, and for highly volatile, it's better to do every year. Other than that, then you do it once in 3 years or 5 years as per your policy. Now, another thing is how do you account if there is a revaluation gain? Or in case of revaluation gain, what do you do? It should be credited to revaluation gain OCI, right? Revaluation surplus OCI, correct? And now, then what to do? Then this revaluation surplus should be systematically transferred to retained earnings by using the formula old depreciation minus new depreciation. That is clear, right? No need to keep it there always. That is why this any asset revaluation will not be reclassified into P&L. It will be going directly from exactly. Now, then what did we then there is a downward revaluation. Then if there is any revaluation surplus that has to be set off and the remaining should only be going to the P&L account. Reverse also true. Okay. Hmm? Right. Reverse meaning if there is a revaluation gain, but there was a revaluation loss, then you have to credit up to the revaluation loss in the P&L account and then take it forward. Hmm? Now let's go to depreciation. What is depreciation? This is pretty simple. So there is nothing too focused about. So let's just go fast. Depreciation amount is allocated on a systematic basis. It is just an application of accrual concept or like matching principle that if asset has 7 years of useful life, we will depreciate it over 7 years. So depreciation is recognized as an expense until it's included in the carrying amount of another asset. Let's say this expense I'm directly attributable to building another asset. I bought a spanner or like some machine for constructing building. Then this depreciation can be added to the cost of the other asset, right? Directly attributable. Land and buildings are dealt with separately even when they are acquired together because land normally has an unlimited life and therefore not depreciated. In contrast, buildings do have a limited life and must be depreciated. Any increase in the value of land on which a building is standing will have no impact on the determination of building's useful life. Okay, so building separate, land separate. Just because land is having an unlimited life, we can't say that building has an unlimited life. Okay. Ah. June 24 examiner's report noted that including land in depreciation calculation was a common error made. Land should not be depreciated at it as an unlimited use. Okay. So review of useful life. Now tell me, let's not go there. Let's just talk to me. What if the useful life was changed from 7 years to 10 years or 10 years to 2 years? Any revision in useful life? How do you account? Prospective. It is a change in accounting estimate and should only be done prospective, just like how we are doing with revaluation cases. Okay. So use should be carried out. Okay. Review of the useful life of PPE should be carried at least each year, financial year. Okay. And the depreciation charge for the future period should be adjusted if expectations have changed significantly from previous estimates. Changes to the useful life are classified as changes in accounting estimates and are accounted for prospectively. Right. I am not doing this question. It's pretty simple. It's just maths. Now you have to review depreciation method also, right? Depreciation method, useful life has to be reviewed once in a year. And if a depreciation method changes, is it a change in accounting policy or a change in accounting estimate? Policy. Hmm? Decisions. I'm shifting from straight line to WDV. No, so this is straight WDV or WDV to sum of digits method or change in accounting, change in depreciation method. Useful life is clear. Depreciation method, prospectively or retrospectively? Prospectively. Estimation. Estimate. It is an estimate only. Why it is an estimate, not a policy? Changing the principles. No, if I do cost method to evaluation method and by the way, can I change? I can change, but only that I have to do it retrospectively because it's a change in accounting policies. I mean, cost or subsequent recognition. But what about depreciation method? See, what they are saying is depreciation itself is an estimate. Okay, so that has to be. So let's read that. Depreciation method should be reviewed at least, and it has. And if there has been a significant change in the expected pattern of economic benefits, see that is the thing. When do you depreciate? You choose a depreciation policy based on the pattern of economic benefits that is arising from the asset. Correct. So if there is a lot of benefits in the immediate short term and smaller benefits in the long term, which method would I use? Say I bought iPhone 17. I am a nut lunatic who buys iPhone 17 right off the market. Next year, iPhone 18 will come. The economic benefits of holding an iPhone 17 is reduced next year, right? So I would normally use a higher depreciation rate in the initial years and then lower depreciation rate in the, I'll depreciate fast. So which method am I talking about? WDV method. Now then subsequently we saw that okay, iPhone has stopped production. They said that 17 is the last model. It is good for another 40 years. That is too much of an exaggeration. So let's say it's good for another 7 years. If Apple has come with such a mention, which they will not, again, it's a hypothetical state of mind. But in such a scenario, would you change your depreciation policy or would you continue your depreciation policy? Yes. Absolutely. I'll make it straight line. I will kind of like, equally distribute over the 7 years. Now, why did you do that? What was the determinant of choosing an account depreciation policy? The pattern of future economic benefits that is going to come from the asset, right? So, how much future economic benefits will come from an asset? Is it a policy or an estimate? Estimate. That is why they say change in depreciation policy is an estimate and not a policy. Getting it? The logic. Eh? Because how much future economic benefits is a matter of, it's very subjective. It's a matter of judgment. It itself is an estimate. Hence, so now if you read, you will understand. If there has been a significant change in the expected pattern of economic benefits from those assets, the method should be changed to suit this pattern. When the change in depreciation method takes place, the change should be accounted for as a change in accounting estimate, and the depreciation charge for the future, current and future periods should be adjusted. Now, why it would cause a little bit of problem in the minds of people who did CA is because in India, change of depreciation method is a change in accounting policy based on the IAS that I studied when I was doing. But for you guys, I don't think this doubt should come because for them, it was a period of relearning, unlearning, and relearning. But for you guys, since you started with ACCA, it won't be any problem. Now, impairment, you know what is impairment, right? How to recognize impairment loss? Right. P&L and reversal. Hmm? Reversal of an impairment loss should be treated as a revaluation increase. That a revaluation increase should be recognized as income to the extent it reverses a revaluation decrease or an impairment loss. So previously we saw revaluation loss, and then if there is a subsequent increase, we'll first credit it to income, and remaining would be going into revaluation surplus. Same logic applies if there is an impairment loss. It need not be only for a revaluation decrease, but for an impairment loss also. Because at the end of the day, both are same. Fair value. Complex assets we already saw, right? There are like, complex asset means asset which has too many components and each component has a different useful life. So what do? We have to find what is the useful life of each and has to be separately treated as a component. Okay, if the useful life of each are different. There is a numerical which is just mathematical. Overhauls where the asset requires okay. Now normally if there is an overhaul, what do you do? Is it has to be capitalized or it has to be expensed on? Your car, definitely a PP, right? Cost can be measured. So what do? If you need an overhaul of the car, would it be capitalized or would it be expensed?
Significant change or increases the economic benefits of the.
What economic benefits would I to increase if I just do an overhaul?
Or
Repair.
Like
the asset is not increasing, its asset is going to be the same for 7 years. No? It's just a maintenance overhaul. It is an annual maintenance, then we can. So what they say is if this is an asset which requires an overhaul every continuous period of time, say let's say I am a car, every 6 months there should be a repair. Now, if that is pretty clear and the asset requires regular overhaul, the cost of overhaul is treated as an additional component and depreciated over the period of next overhaul. Correct? Since your car is getting overhauled every 6 months, it is less than 1 year, so it is not treated as a separate component. But let's say your phone, once in 3 years, there is a. So that means now I purchased a new asset that is overhaul, which has a useful life of 3 years. It has to be treated as a separate component. Okay? So you have to use overall and depreciate it over the useful life.
Like engine oil.
Not engine oil. Engine oil you have to change every 6 months. So it is not more than 1 year. So we will not be treating it as a PP.
So 6 months, 1 year engine oil. No. Based on kilometers, maybe വണ്ടി ഓടിക്കാതെ നടക്കാണ് ഞാൻ നാട്ടിൽ നിന്ന് വരുമ്പോൾ മാറ്റിയത്.
And still you have to change. Hey, if it is available for 3-4 years, then fine. You can choose to keep it as a separate component. But again, if you're not getting any economic benefits from the asset, then whether the question of the asset being a PP itself becomes a big question mark. You have a car in India. You are here. And you are going to continue here permanently, or like in the UAE. So, what economic benefits are you getting from that car in India? Nothing. So, the possibility of it being recorded as a PP, initial recognition, it is probable that future economic benefit should flow. There is no future economic benefits. The probability itself is shut, right? Especially if you are a business. Okay. So, retirement and disposal. When do you retire or dispose an asset?
Future economic benefit.
Very good. It is transferred.
Control.
Ownership and control is transferred. How do you do the accounting? Take whatever is the cash. That means credit, PPE, debit, accumulated depreciation, debit, bank, whatever is the remaining is profit, and it has to go to P&L. Now, if you are retiring or disposing an asset, what happens to a revaluation reserve that you have in OCI? This is very clear. P&L account entry is very clear. What to do if you have a revaluation surplus? Huh? So when a revalued asset is disposed of, the entity can choose to whether to leave the amount in revaluation surplus in equity or transfer it directly to retained earnings. Any revaluation surplus may be transferred directly to retained earnings. Alternately, it may be left in equity under the heading revaluation surplus. Transfer to retained earnings should not be made through P&L. In other words, it must not be a reclassification at all. Again, I'm telling you, that is why this thing is taxable. Okay. Any gain on revaluation of property, plant, and equipment is not an item which would be reclassified. There are two ways in which it can be debited. One is you are debiting it directly to retained earnings over the useful life of the asset. Right? I earned this revaluation from this year, and matching the depreciation increase, you are crediting it to retained earnings. Or at the time of disposing the asset, again it will go directly from revaluation reserve to retained earnings. It will not go through P&L. Very important from a tax point of view. Can I have the charges? Okay, that is the then you can de-recognize. When do you de-recognize an asset? When you're selling it, correct? Now, de-recognizing an asset plant it on the date of, so it should follow the criteria for sale in IFRS 15. What is a sale in IFRS? When does a performance obligation satisfied? When the control is transferred, you can de-recognize from your block of asset. Okay, that is all. This is very simple questions. We will quickly go through depreciation accounting because any doubts so far? Huh? It is pretty simple. Let's rewind one more time. For an item, it should first meet the definition of PPE. Huh? Then second one, to recognize, it has to satisfy two conditions. Initial recognition. It is probable that future economic benefits. We talk about the painting and MSD bat and all. It is probable. You don't need to find surely certainty and all. No. It is probable that future economic benefits will flow to the enterprise and the cost can be measured. Then you can now you have to record it at cost initially. Every asset, no matter what, has to be recorded at cost. I mean, every PP. And then while measuring cost, you know what elements to take directly attributable to bring the asset into its present location and situation. Okay, if there are overheads which cannot be directly classifiable, expense it off. Don't take the risk of capitalizing it. Okay, and it is only to bring the asset to its present location and condition, not for any other. Say training to staff and all is not to bring the asset; it is to train others how to use it. So it will not be capitalized, right? Then that is initial recognition. Initial measurement is also this. Then there is subsequent expenditure. When do you do? When it increases the useful life of the asset, right? Or let's say that I am attaching a new component altogether, which would have so it is increasing the economic benefits associated with the assets. Or I do component accounting, de-recognize the component and add the new component, right? So this is subsequent expenditure. Now, subsequent measurement, either at cost or revaluation, as a revaluation model. By cost, it is cost minus accumulated depreciation minus accumulated impairment limits. Revaluation model, it is revalued amount minus subsequent depreciation minus subsequent impairment losses. Now, there are few more things which you have to take. One is if there is a revaluation surplus, then to the extent it is first credited to P&L for any previous impairment loss or revaluation loss, then only it should go to OCI. Reverse also same. That means initially I had a revaluation gain, now I am a loss. That loss should be debited in P&L after setting of OCI. Okay. Now, whether this revaluation surplus in OCI can be transferred to retained earnings? Yes, it can systematically over the life of the asset. How do you calculate that? Old depreciation, new depreciation minus old depreciation. Okay. Now, then what did we kind of looked at? Then the reverse also goes the same every time. Then we talked about depreciation. Overhauls. If it is a component, if it is an overhaul which is happening every 3 years, or like every systematic period, then use it as a component itself. Okay, if it is more than 1 year, then you can count it as a component. Depreciation, change in useful life, change in depreciation method, all accounting estimate. Okay, this is PP. Now they have given something like depreciation accounting. It is nothing else. It is not a IFRS, but it is just to kind of give some clarity on depreciation. Okay. So why do you depreciate? Because asset wears out over time, right? It is nothing so nothing that you guys don't know. So what is depreciation? Depreciable asset, useful life, depreciable amount. Now, one thing important that I want to tell you is depreciation. What is the formula for finding depreciation? Divided by 100. It is only for straight line and other methods. For WDV, we will take the cost itself. And did you understand what I said? I'll tell you. Okay. That is the only thing. Like, it's WDV, you take the full cost into what is the. Okay. So you have to be depreciable, be allocated on a systematic basis. So there is nothing much that needs. It's an accrual assumption, right? and it does not result in a fall of value. It does not fall of value. It is just expense recorded for the normal wear and tear of the asset. So useful life is an estimate. Correct. Useful life is an estimate, and any change should be. Now, residual value is nothing but scrap value. Depreciation methods, you understood how you calculate, how you find out a depreciation method, right? Based on the future economic benefits associated with the asset. Now, what are the different types of methods? You can use any method. There is no express limitation like LIFO for inventory that is given in this case. You can use the principle based. Whatever method we use should portray the economic benefits that is received from the asset. Take in mind the iPhone example. Based on the economic benefits associated with the asset, we will do depreciation method. There is no hard and fast rule. You can't use this or not. So, what are the methods which people use? Straight line method. Yes, there is something called uh, on the basis of production, on the basis of consumption, we can use, or there is something called sum of digits method. Sum of digits method. It's nothing so important. Like, it will not be tested, but for your academic thing, okay. So let's say that there is an asset, okay, of $10,000. Hmm? How many useful life? I'll take 5 years useful life. Okay. And a scrap value of 1,000. Now let's do WDV method. Sorry, let's do SLM. How do you do SLM? So what would be the at the end of year one, what would be the depreciation value? No, we are busy. What would be the depreciation value?
10,000 minus 1,000.
So
9,000. 1,800.
so first year it would be 9,000 minus 1,800, right? Then second year it is going to be 9,000 minus 1,800 into 2. And what is going to happen? We will do 3, we do 4, we do 5. Only problem is it is not 9,000, it is 10,000. Right? Okay. So the end of year 5, 1,000 is the scrap pearl. Okay. Now what about WDV? They will give a percentage. So let's say it is 20%. Okay. So first year it is going to be how much? Yeah. Okay. Now second year it's going to be it is going to go even further. It will go to year 6 also. We'll take 25% for Hmm? Okay. Now you see the difference between both these methods. First year, it gets massively depreciated. See the carrying value? This is all carrying value. Okay. So from 8,200, it goes to 7,500. Then 6,400. Then slowly, what happens? This picks up. In the fourth year, if you see, SLM value is more than WDV. So when do I use WDV? When there is initially a lot of consumption and it will kind of lower to the end. Right? Okay. What is the depreciation I'll put in year 7? How much would be the depreciation I will do in year 7? I will only depreciate for 780, not 1,780 into zero point 0.8. So remaining would be. Now, what is the sum of digits method is? It's just not very scientific. What they do is, now there are 5 years, right? So I will sum the digits. 5 plus 4 plus 3 plus 2 plus 1. That would be how much? 15. And then I will do in the um, sum of digits method. I will do it. So right now it is 10,000. This is the depreciation. Okay. 10,000 into 5 by 15. Then 4 by 15, 3 by 15, 2 by 15. That will get you the depreciation. That minus that would be carrying value. Again, this is similar to WDV only. 5 by 15 in the initial period, then 4 by 15, then 2. So it's just initially there would be a big slump. Then this is sum of digits method. It's not very frequently used. Okay. So this is what machine hour method, how many machine hours? Sum of digits method is just the sum.
So SLM method നമ്മളൊന്ന് ആദ്യം സ്ക്രാപ്പ് ടു മൈനസ് ചെയ്യണം ഫോർമുല.
Because I want the end to be this value. Okay, I am only depreciating the non-scrap value. 9,000 is depreciated over 5 years. So after fifth year, if I depreciate 9,000, I will get a 10,000, 1,000 balance. It's just common sense. Okay. So this is straight line. This is way. See the usage one. See the sum of digits method. Each year, what is going to be the depreciation? If it is okay, there is nothing much in depreciation. This is just max. There's absolutely nothing in. And that completes 16. Okay. Tomorrow we'll start with 20. 16 is simpler. Only thing is, we'll go by this. And if we have time, it's only 11. So what I will do is let's do a comprehensive problem on 16 so that you get to know what. This is how the questions on 16 will look like. Okay. I'll do only one. There are plenty of questions, but this is the most cumbersome one. Yes. Yes. Somebody read.
On 1st November 2020 export, Gamma placed an order for machinery which was to be used in a new business venture. The initial cost of the machinery was $30 million. The machinery was delivered on 30th November 20 export. The machine required further development and installation of Gamma's devices. This was carried out by the supplier and took from 1st December 2004 until 30th April 2005. The total additional cost of this development and installation was $60 million. The supplier allowed Gamma 2 months credit from the date of completion of the installation. On 30th June 2025, Gamma paid $90 million to the supplier.
Okay, before that, how do you read a question? First, you have to see what is to be done. Okay, so required, explain and show the above event would be reported in the financial statements of Gamma for the year end. So we have to explain and as well as show. Okay, and how it would be recorded in the FS for 30th September 25. So now we know that what is the year end date. So everything should be on the mindset that we are how it would be recorded as in 30th September. Okay. Now you read the first one. What does it say? On 1st November. So is it within my financial period? 30th September 20x5. Yes. I placed an order for machinery. I placed an order for machinery. What entry would I do that time? On 1st November? What entry would I do on 1st November? I won't put any entry. What would I put if I placed an order? The initial cost of the machinery was 30 million. Okay. Machinery was delivered on 30th November. Would I do any entry then? Huh? Because I should now the machinery is come to my premises, the control has been transferred to me.
Placed an order for machinery.
Yes.
So at that time, what if we made the payment?
Is there anything that was given in the question regarding payment till now? The initial cost of the machinery was 30 million. The machinery was delivered in 20 export. Now the control has been transferred to me. It's delivered. The machine, so what do I do? First of all, we have to understand that is it a PPE? Is it going by the initial recognition condition? And then we will credit it as PPE 30 million on 30th November 20 Expo. The machine required further development and installation at Gamma's premises. This was carried out by the supplier and took from 1st December 24 until 30th April 25. So the total additional cost of this development and installation was 60 million. What do I do with this information? You have to explain and show. Don't just say one word. You will not be able to write the exam. You have to explain, give all your thoughts onto this. So tell me, what do you do with this information? Right. Is it a directly attributable cost to bring the machine to its present location and condition? Okay. So the supplier was doing this from 1st December to 30th April. The total additional cost is 60 million. The supplier allowed Gamma 2 months credit from the date of completion of the installation. On 30th June, Gamma paid 90 million to supplier. Why 90 million? 30 for the equipment and 60 for the installation. So when would I incur 60? Over the period of time from 1st December to 30th April. Okay. Would it be PPE or expense? Should be PPE. Following the installation of the machinery, the employees attended a training course to ensure that they could operate the machinery. The training was completed on 15th May 20x5. Okay, it's still within, we are looking at FS for 30th at a total cost of 1 million. Under the legal regulations in the country in which Gamma is situated, a safety certificate is necessary for the machine to be legally used. On 30th May 20x5, the machinery underwent a government inspection and safety certificate was issued. The cost of inspection and safety paid on 30th June 25 was 600,000. due to economic uncertainties, the machine was not brought into use until 31st July. Now, what is this information? I did some employee training on 1 million. Would it be PPE or expense? It would be an expense. The training was completed on 15th May. Oh, sorry. At a total cost of 1. Under the legal regulations in the country in which Gamma is situated, safety certificate is necessary for the machinery to be legally used. Now you tell me, till when would I capitalize the asset? When it is ready for use. Correct. Machine was delivered on 30th November and it was installed also by 30th April 20x5. Can I use? It's ready to use, right? Should I capitalize this cost? Safety certificate. Yes, because to be legally used, you need that. So that means it is not ready for use yet. This would also be needed to ready for use. Now we got the date at which it is ready for use. When it is ready for use? 31st May. Why July? 31st May 20x5, the machinery went a government inspection and safety certificate was issued. I got the safety certificate. I got it installed.
But due to economic uncertainties,
Ah.
the machinery was not brought into use.
So what should I do with that information?
Information.
Date onwards.
After getting the safety certificate on 31st May, isn't it available for use? Correct? Just that we are not using, would it be any grounds for not depreciating it?
No.
Absolutely not. So the cost of inspection and safety certificate was paid on 30th June. This was payment. And would this be capitalized? Yes. Due to economic uncertainty, the machinery was not. It is not relevant at all. Okay. It was available for use. Now, new business venture in which the machinery is being used is one which qualifies for preferential loans. These loans are 12 months duration and carry an fixed annual interest rate of 4%. They are available on 1st November each year. Therefore, from 1st November 24, Gamma borrowed 90 million and repaid this amount. So, for financing this, they borrowed money at 4% interest. Now, tell me, what is we are not gone into IAS 23, but you tell me, what should I do with this piece of information? Capitalize when what? Okay, so you tell me from when to when should I capitalize? See, I got the loan on 1st November and I paid it back on 31st October. So I effectively incurred how much of interest? 12 months interest.
1st November till 31st.
1st November till 31st May.
1st November ಅಲ್ಲ.
First November to
ಅಲ್ಲ 30th
June. First November on loan.
30th November.
You should start from the date of order or date of delivery.
Supplier allowed Gamma 2 months period on the date of completion.
That's okay. So total 12 months interest I paid. Correct? That is from 1st November 20x4 to 31st May 20x5. Sorry, to 31st October 20x5. Correct? Now, what is the time with which we are doing it for which year? 30th September 20x5. So how many months interest was paid in this? We paid 11 months interest because 31st October falls in the next period. Okay, that is number one. Out of 12, 11 months it is accountable. Now, what is to be capitalized? What is to be written off? Out of this 11 months interest at 4%, what is to be capitalized? What is to be written off? When should I start capitalizing interest? We know for a fact that on 31st May we got the safety certificate. On 30th November it was delivered. On 30th April I got my installation done. By 31st May I got a safety. Now I can run. So definitely the end date is 31st May. Tell me the beginning date. Huh? It should be 30th November. That's when the item was delivered. Right. Again, I told you 30th November is when we will calculate PP, correct? I mean, that is when the PPE was delivered. So interest from then alone would only be capitalized. So 30th, so 1st December 20x4 to 31st May 20x5. So that means how many months? December, January, February, March, April, May. 6 months capitalized. And how many months written off? 5 months written off. See, it's going to be tricky. It's going to be tricky, but you get stick to your basics. When did you recognize PPE? It was only delivered now. How can you do a prior period, capitalization on that? So you can't. So that is how, and then estimated useful life of the machinery is 10 years. However, the machinery's engine will require replacement after 5 years. The current replacement cost of the engine is 24 million. Gamma estimates that the replacement cost of the engine in 5 years' time would be 30 million. What would you do with this information? That's okay. So, in the current year, should I not do anything?
Separate depreciation volume.
So, what is the amount at which I will recognize the engine? So, 24 million would be for engine. And how much would be for others? We paid 90 plus 600,000 for the safety certificate also. So the total is 96 million. Correct? Out of 96 million, 24 million is engine. 90.6. So out of 90.6, 24 million is engine. And the rest is other. So see how much you have to write for 15 marks. First thing you have to see is if there is 15 marks, there should be 15 points. So I just made an attempt to write. Oh, it's not there. Okay, I had written this, but unfortunately it's not seen. That's okay. So you have to write 15 points based on put your knowledge completely, when to recognize, when to do, how to kind of do, what would be the rate, how to do about the component accounting. See the complexity. See, this may be okay once you understand the logic, but writing this in a high pressure exam situation needs practice. That's all. This is the most gundest question I could find. Others are less than easy, but don't get okay.
Last week 30 million.
That won't be relevant. That is just to confuse you. So for the current year, while recognizing 24 million is the number which we'll take for 30 million is the cost on replacement after 5 weeks. Why would I need that information now? Right? Or what I could do is if they have given an interest rate or something, 30 million I would have to expend 5 years afterwards. So its present value would give the current replacement cost. So out of 90.6, 24 is pertaining to engine, which will account differently as a component accounting so that the useful years would, since the useful years does not match, I can de-recognize and add it after 5 years. Okay. This is the kind of level of questions. It's not easy. And once you start writing this, becomes even harder than discussing like this because too many information, too many things. First thing, always what to do is see what the exam question is. Okay, then see how many marks it is. Okay, here it says explain and show. So to explain and show how everything would be accounted. Right. For 15 marks means 15 points. So you should pick 15 points to explain and show. Hmm? And marking would always be 1 mark per answer. So more points, more chances of you getting more marks. Okay, more the merrier. That should be the mentality. So if you don't want to complicate it and one big sentence, instead of that, break it down. That is the way they are expecting the answers because it's easy for them to read also. Okay, IAS 23 we are not done, but the rest of the things should have been there.
ഈ എക്സാം പറ്റുമ്പോൾ ഒരു ഡെഫിനേഷൻ വരും.
If you write, that's better. You don't need to reproduce the exact one, but the idea should be, you should show the examiner that idea should be clear to you. For example, PPE. You don't need to put the exact definition, but say as per IFRS 16, IAS 16, and write study the name of the standard also. IAS 16, property plant and equipment. Okay, this is what is to be memorized. Rest of the things, if you write, okay, basically a little difference in words and all is fine. Principally, it should be correct. Okay, so let's stop here. So tomorrow,
ആൻസർ ഉണ്ടോ?
answer is not there. I solved it for you, but I think the Excel got deleted or something. Let me see. Did I do it here? This is not. This is our old one. This answer I did actually, but can't find it now. Good that I really had the question, but you will find this in the revision guide. This is all taken from the revision. Okay. And questions will not come like this in the sense like it would be 2, 3, 4 standards merged together. So it's rare to find one standard asked for 15 minutes. Okay. Then it becomes easy. And there are multiple standards being put. Now imagine you doing 15 and 16 together. It's a little hard. Whenever there is a question on 15, it is going to be hard. 16 is still fine. 16 or PPE cases is still you will get it. 90% you will get it. Some mistakes here or there if you don't prepare, but 15, unless you go through the things, you will not understand. Okay. So tomorrow we'll continue with 20. Okay. Then we have 20 is a very simple standard, but you need to understand. Yeah. So we have 20, 40, and 23 for today. Okay. If you are done, then we are done with 4. This will take only 1 day, even lesser, because it's pretty easy. This will take 1 full day. But unless you know how the accounting goes, then it's pretty simple. This is also simple. This is also simple. You just need to understand the logic. There is not much things going on. This is a little vexing. Unless you know this before how to do this, otherwise it would be a little tough. Okay. You just need to know a little bit of financing also. This will take 2 days solid. This and all I'm not even taking because you guys do this here. Yeah, this we will do. This and all is very small. This is also not much. Then we will go to presentation. So I have 10 chapters to do in coming 10, 15 days. Okay. 15 days till 7th, till I'm there. We'll try to complete till 14. And then there is presentation and disclosure, which I want to spend some time because they have changed, since IFRS 18 has come, how exactly are they presenting is a little difficult, and they want you to use this presentation in explain and show. So this is something new which we should study. We will do that once I am back. See, now you have to do operating, investing, financing, income tax, and discontinued operation. This is just like a cash flow. Operating profit and loss without financing. So this should be very clear. Right? By function, by nature. We looked at by function, by nature, and all in the first conceptual framework. Does anybody remember conceptual framework? Okay, anyways. So this is going to be something new which would take some time. And of course, then we have to do console also, which is a sure shot 25 mark question. Okay, so November is going to be busy. And definitely we'll get time during that Eid holidays to do revision. Sorry, not Eid holidays, because it's going to be a long weekend.
Summer election. National election.
No, some fifth. We'll have time to do some questions, but just try to do more. Okay. So that's it. So let's meet.